But what I thought would be important is to show you the thinking process that goes behind it and how I'm underwriting it, so that maybe if you're looking at industrial properties, this is an industrial building, but the same holds true for most triple net commercial properties. Okay, so this is really what I call the BOE, or the back of the envelope. And this is kind of learning how to calculate financial returns in probably about 5 minutes. Okay, so I'm going to share my screen here. Let me just do that right now. Okay, so hopefully you can see this. And really what I want to start off with is I'm going to give you a little bit of language just so that we're all on the same page. I mean, this is literally training that I go through with private clients. Okay. But what I want to do is just, expose more and more people to this. So there's a few things that are going to be really important to understand. We're going to calculate the cash flow. Then we're going to calculate cash flow with debt coverage with leverage, so your DCR. And then we're going to test some assumptions. Now, I'm not going to go into all the assumptions because that could literally be like an hour-long conversation. And how am I thinking about this? It's going to be very property specific. So that's more of the art. Today, I want to give you the science of how to underwrite a deal really fast. Okay, so I think the big number that most people focus on, or in terms of returns, especially when investing in commercial real estate, is the cash on cash calculation. And I mean, it's really the easiest. As soon as you start applying leverage and some assumptions in terms of like what are rents going to go, what are rents going to do in the future, what's going to happen with some of your expenses, CapEx, TIs, tenant improvements. Those are all going to impact your cash on cash. But just understand that we're going to focus on what's the cash on cash today, going in returns with and without leverage. And then what are the cash on cash returns into the future, primarily with leverage, because we're not going to buy, most people don't buy real estate all cash. Okay. Now, a couple of the basic questions. This comes right out of CCIM. So if you're experienced in commercial real estate, you'll know this. If not, then this would be a really good primer. So the four basic questions are: number one, how much money is going into the investment? Number two, when does the money go in? Number three, when does the money come out? And number four, how much of the money comes out? Okay. So those are just really important questions. If you're going to invest passively or actively, those would be questions that I would be, asking anybody that I'm looking to invest with. And it's surprising when I see pitch decks where people are trying to raise money and they haven't answered those four basic questions. All right. So how do you actually calculate a BOE? And a BOE is simply a back of the envelope, back of the napkin, whatever you want to call it. So there's a couple of key things that I'm always looking for. And they generally start with, what's the asking price? What's the purchase price? So the property that I'm looking at right now, I'm going to change the numbers just to protect the innocent. But let's say it was listed for 7 million. Well, in reality, I could buy it for closer to 5 million. So sometimes just because something is listed on LoopNet for a really big and inflated number, does it happen all the time? No. But does it happen? Certainly. It's not like the MLS where you're buying houses and it's probably going to trade within a fairly small bandwidth. Commercial real estate can be it can be quite far off in terms of what is someone's asking for it. I mean, I literally just came from a coffee with a gentleman. And when the property first came out, it was closer to 7 million, and he offered, and the valuation was closer to like 4.5. So, anyways, those can occur. It would be unlikely that you're going to see a $600,000 house actually trade for $400,000 on MLS. I suppose it happens, but I'm not that familiar with residential homes being that far out of whack. Okay, so enough on asking versus purchase price. What's your rehab cost? What's it going to cost to actually improve the value? What's the cap rate? So the cap rate, simply put, is if a building is $1 million and the NOI, or net operating income, so that's basically the free cash flow after all expenses, is, let's just say, $100,000, that would be a 10 cap. Okay, so basically if you buy the property all cash, what is the return you're going to get on that money? Obviously, if you only had the same $1 million property and it was a $50,000 of NOI, that would be a 5 cap. So generally speaking, investors are looking for higher caps. Now, usually a higher cap rate might imply more risk, right? Because if there was a lower cap rate, lower returns. If someone's prepared to get a lower return, you would expect lower risk. Okay, so we're not going to get into the nuances of that. Those are just broad brush assumptions that most investors would probably make. Okay, we're going to look at cash on cash return. I'm not going to take into account some of the closing costs and so on, because I want to keep this simple, right? When I'm doing a back of the envelope, I literally will do this in 2 minutes. Okay, so with that said, let's get this out of the way. Let's get into, we already talked a little bit about that. Some of the more advanced factors. I'm not going to get into IRRs or net present values, although on this particular property, I did run those numbers, because we're looking at this saying, okay, here's what the building looks like today, but in 10 years or 15 years, at the end of the life of this particular property, we're looking at it saying we may redevelop it. All right. That's a little bit more advanced. And so in doing those type of calculations, you might look at a net present value or an IRR. And so that takes into account your cash flow over the duration of the life of the property. All right. So you can certainly do that. There's lots of calculators online, but we're going to keep it a little more high level, because the BOE, I would never start with a net present value. I'm going to start with what's my cash on cash today once it's levered and unlevered. Okay. We're not going to do that one. We're going to do this industrial building. Yeah. Okay. So this is not a picture of the actual property, but it would look, this is a typical industrial, this is a obviously large bay. We're looking at a larger single tenant industrial building. And in this case, we're going to assume it's a $5 million purchase price. We're buying at an 8% cash on cash, which essentially would mean we're getting net operating income of $400,000, right? So you would just go 5 million. Here, let me just do this. All right. So purchase price, 5 million, cap 8%. Basically, that's 5 million times 0.08 is going to equal 400,000. Okay. So that's my NOI is 400K. Now back to the property here. So we're going to assume 75% leverage with a 25-year amortization and 5-year money at 4%. Okay. So the actual mortgage would probably be a little bit less. And we may actually go for 10-year money. Okay. But we're just going to keep it simple. The principal and interest is going to be 238. So I'm going to, I'm always reluctant, but if you don't have this calculator, this is a really slick way of calculating returns. Okay. So I have this app. It's also the same financial calculator. It's a 10B2. And so I'll just do a high level. Okay. So we're basically going to go $5 million is the purchase price times 0.75. So that's my present value. So I'm going to hit that right here. So the present value. So 3.75, a 4% interest rate. And we're going to plug that in there. And we're going to go 300 is my N, because it's going to be monthly. Okay. And now we're going to calculate payments. Okay. So that is essentially what this is going to cost on a monthly basis. Times it by 12. So there you go, 237. So if you go back over here, I think I just rounded up to 238. Okay. Now, when we go back over, now let's say I want to say how much am I paying down the principal in year one? Okay. So I'm just going to go 12 input, and then I'm going to go, I know this is kind of geeky. Hopefully that you find this valuable. If not, I won't do these anymore, but I think sometimes people appreciate this. So you can see at the end of the year, my mortgage went down from 3.75 million to 3.66 million. So essentially that's about 90,000. Yeah. What do I have? $89,000 a year. All right. So if my initial equity was 1.5 million, my cash on cash return is going to be, so I'll go back here. Okay. So if you remember, we had $400,000 of net operating income, and we're going to minus the 238,000, I think it was. Yeah. So 162 is my free cash flow, right? Which is what we have right here. And then if you want to take that one step further, you say, what's my actual cash on cash? You divide it by the initial equity that you put in, which is 1.5 million. Boom, 10.8%. All right. So now if you want to calculate how much it is with your principal pay down, you would just go 162 plus the $89,000, and that's going to equal 16.73% or 251. Okay. So that is a snapshot on year one. Now let's flip over to year two. What is this going to look like? And let's make the assumption that we can raise the rents by 10%, and we're going to hold the building for 10 years. Okay. So we've got NOI at 400,000. We're going to increase it by 10%. So now the NOI is 440. So our year two cash on cash is going to go from 162. We're going to add 40,000. So it's 202,000 or 13.5%. If you're listening to this on the podcast, it's probably going to be a lot more effective if you're watching the YouTube video. So just go to my YouTube channel and you'll be able to find this. Next is you're going to hold the property for 10 years. All right. So we're going to assume, now I could have said, 162 in year one plus 9 years at 202, but I'm just trying to keep this really high level and simple. I mean, if you're going to do this and you're presenting it, you would certainly want to contemplate that. But just to make the math really simple, we're going to say that you're going to collect $2.2 million over 10 years. All right. The outstanding principal, right? So if we go back to this right here, I'm going to enter in 120 input. This is the shift function, amortization. So at the end of year 10, this is the balance, right? After 120 payments, which is what I have here, 2.675 million. All right. So your principal pay down goes, you pay down the mortgage by about $1 million. Now I call that phantom income because you can't actually realize it until you sell the property. Now we could get into, how long is it going to take to sell and what is the leasing, what's the commissions in order to do that. But like I said, we're just going to keep this really surface right now. And then like the reason I do a BOE is to run these numbers. If the numbers make sense, then I start to really drill down, go into a lot more of the assumptions. How long is it going to take to increase the rents? Am I going to have to put any tenant improvements or TIs into the property? Am I going to have to pay a leasing broker? All those kind of things are going to impact. But maybe I don't get 10%. Maybe I get 15% on some of the property. So, just take into account you're doing this at a high level because you don't want to waste friggin' 3 days trying to find out if this is something that you even want to get into. Like literally, I don't know how long I've been on here and I'm explaining it while I go through. If I was just doing this on a blank piece of paper, I'd probably be done, 5 minutes ago. Okay. And the last part is just to look at it on a macro, right? So a recap on some of the things we've done. We are using the same cap rate, right? So if you go back here, we bought it at an 8 cap and we're going to assume the value has not increased, right? Now you might say, oh, well, that's not realistic. Once again, those are assumptions that you can make, but for the purposes of a BOE, we're going to assume the same. So if it's an 8 cap, when you add $40,000, you increase. So if you think about what we've done here, we've increased the rents by 10%. And we've increased the value by 500,000. And so if you look at what this what putting leverage on this building, right? Because you put in $1.5 million and you've increased the value by $500,000. So really by increasing the value of the property by 10%, the rents by 10%, you've actually increased your equity by 33%. All right. That's the power of leverage. It goes the other way too, right? If your rents drop by 10%, then you can lose 33%. So just keep that in mind. Now, at the end of 10 years, you sell. So you got cash flow, 2.2 million. Your mortgage goes down by $1 million, and then you increase the value by 500,000. So in total, you're, assuming you sell the property, you'd have about $3,774,000 of increased of equity. Okay. Now, obviously, you're gonna have sales commission, so you might plug in 2 or 3%. You could deduct that out of there. Not factoring in taxes, because if you're in the US, you might do a 1031. Up here, let's say you just refinance, you pull money out. There's lots of different strategies, right? There's multiple ways that you can stair step this one deal into more deals. I'm not even talking about how you could syndicate this deal with, let's say $100,000 of equity of your own money, raise the balance of it, and really kind of push your own returns. This, like I said, assuming a person's coming in with $1.5 million of their own equity. All right. But you can see here on $1.5 million, you got a 25% annualized return, right? This is not an IRR. We did not calculate an IRR. We didn't do a net present value. All we're doing is a simple calculation over time. So that is a BOE. Now, how do I get out of this? Let's just see. Okay, so let's go back here. Now, that I think is going to be helpful. I know when I show this to clients that they appreciate it. A few of the assumptions that I think would be important to kind of discuss real quick are you buying this building at or below market rents? That's number one. Number two, what are the brokerage fees for leasing and for sales, right? We didn't take that into account. What are your TIs or tenant improvements? What's it going to cost to renovate this property? What is the market vacancy, right? There was no vacancy factor plugged in here. And I didn't say whether or not this was a 5, 10, 15% vacant building, right? So you would want to ask that question, especially if you're looking at buying this. And I'm not going to get into those specifics because, like I said, if I give away too much detail, then the broker that showed me this deal is going to get pissed and he's not going to show me any other deals. So I'm just keeping this, trying to be as helpful as possible, but still obviously respecting everybody that's involved in the deal. Now, some of the questions you might ask are, number one, what's the replacement cost of this building, right? So I didn't say what the square footage was or what the rents were, but let's assume that this building was, I'm trying to, I don't want to be, so let's say it was 25,000 square feet, right? So it'd be $200 a foot. If it was 50,000 square feet, then it would be $100 a foot, right? You should know how much it's going to cost with land, right? With so for example, in industrial buildings, you might get 35 to 40% site coverage. So if you're paying $1 million an acre, you should be able to figure out what your price per land foot is to build something new, right? It might be $70 a foot. And then let's say you are constructing brand new tilt up concrete, you might be 100 to 125 a foot, right? Then what are your soft costs going to be? How long is it going to take to get that? What are the development fees, et cetera? So once you understand that, then you can start to say, yeah, you know what? I'm buying this well below replacement cost. I like this. Okay. Some of the other questions are, is the building functional? What's the ceiling height? What are the loading? What are the parking, the turning radiuses, et cetera? So those are all factors that are going to come into play specifically for an industrial building, right? If you were doing retail, it'd be much different. If you're doing multifamily, different. But I know a lot of people have been asking about industrial lately. So I thought, you know what, I'm going to share some of this. A few of the other questions you might want to ask: can I demise the building? Right? Let's say it's a single tenant. Can I cut this building up, and will it lay out well? Will it be too expensive to demise 50,000 foot into 10,000 foot? Right? That's a question that you're going to want to maybe consider. What's the bay depth? Right? Is this good for the type of user that's going to come in here? Is it dock level or grade level? I mean, these are once again very specific questions, but you want to understand who your tenant is, excuse me, and what they're looking for. Okay. Yeah, we talked about key metrics. We talked mostly about that. So let me just flip over here one last time, and we'll just talk about kind of a quick recap. I got to go quick because I've got a call coming up here. All right. So we talked about understanding the language of commercial real estate. I think the really big ones are cash on cash, cap rate, and then just understanding debt coverage ratio or leverage returns. Okay. So those would be really high level. Next, in terms of doing a basic back of the envelope or BOE, I would look at what is the unlevered return. So it's essentially what's my cap rate. And then how are you actually calculating the NOI? That in and of itself can be a little bit of a science. I mean, when I was a broker, when I first started off, I mean, you'll spend 6 months to a year just underwriting deals constantly. That's really what you're doing. And so if you're just getting into commercial real estate, what I would suggest is look at lots of deals, right? Go to, we're not going to have time today. I found a few properties here on LoopNet that I was going to show. I think I'm showing you guys this right now. But like I said, I don't, I just don't have time right now to go through all these, but just understand that there's lots of properties, find them. I wouldn't necessarily call brokers if you don't have any kind of sincere interest. You can certainly, but just understand that they're generally pretty busy and they're gonna vet you very fast. It's not like residential real estate where brokers are generally happy to get a phone call. Not saying commercial brokers aren't happy, but they're usually either touring or negotiating a deal. And so they're going to weed out people that are just kind of kicking tires. So if you have an interest, certainly, but you can do a lot of research just on LoopNet, CoStar, whatever it happens to be, and find out the basics of the deal, and then figure out, yeah, you know what, this is kind of what the returns would look like. You're just getting the reps in. That's probably the best way to put it. So unlevered return, leverage returns, right? So talk to a mortgage broker. How do I know 4%? How do I know 3.75% with a 25-year AM? It's because I'm talking to brokers constantly, right? I know I have a very high level sensitivity in terms of what bond rates are doing, what are the spreads, how much can I borrow money for, right? And that really helps me to hone in on what kind of debt I'm going to be able to achieve on a specific property. Okay. I'm going to look at returns today, returns tomorrow. What's the value add? And then we didn't get into all the different types of assumptions, but like what can hurt me? And am I what I call blue sky thinking? Blue sky meaning like, is everything optimistic in the sense that everything has to go right for this deal to work out? I see way too many new real estate investors. They are blue sky, and that can be problematic. We'll just put it that way. I've seen people lose millions of dollars on deals because they were blue sky. And that's why sometimes having an outside perspective can be really helpful, right? An outside perspective can basically say, hey, have you thought about X, Y, and Z, right? So take that into consideration. Okay, that's what I wanted to cover today. A little bit longer than I thought, but I hope that this is valuable. If it is, let me know in comments below. If you're watching this live on Facebook, if you're listening to the podcast, you can certainly email me. Go to my website and let me know if you want to see more of these kind of deal breakdowns, BOEs, if you will. Happy to do it. If this was too much in the weeds, I can keep it more surface level. It's really, I want to make sure if I'm going to do these, I'm going to put 20, 30 minutes in plus 45 minutes of prep that you're getting value out of it. So that's all I got today. Have a great week. And I'll keep you posted on whether or not this property comes together. Bye for now.